All right, today we're going to do something a little different. We're not just looking at a stock, we're breaking down the entire professional process for analyzing a trade. And we're going to use the retail giant Walmart as our case study. This is all about process, discipline, and making smart, informed decisions.
So here's the core of it, the big question we're facing. We've got a fantastic company. I mean, Walmart is absolutely firing on all cylinders. But the stock is expensive. It's trading at a really high premium. And that creates this classic conflict that every serious investor has to solve. Is a great company a great investment at any price?
Okay, so to tackle this, we need a solid game plan. Here's how we're going to do it. First, we'll dig into the dilemma itself. Then we're going to pull up the price chart and decode it to find our key levels. After that, we'll explore 4 totally different strategies an investor could take. We'll give you the professional's verdict on the best path forward, and then wrap it all up with a pre-trade checklist you can use yourself. Let's get started.
All right, first things first, let's dig into the numbers behind this whole conflict. Because before you even think about risking your capital, you have to understand both sides of the argument, the good and the bad, with total clarity. Okay, the very first number that just jumps off the page is the price-to-earnings ratio, or PE. It's sitting up there at 40.47. For those who don't know, this is a really common way to see how expensive a stock is. It's basically telling us that investors are willing to pay over $40 for every single dollar of Walmart's earnings.
But look, a number like that doesn't mean anything on its own, right? You need context. And when you compare it to other companies in the same sector, Walmart's valuation is at a staggering 101.3% premium. To put it simply, you're paying more than double for Walmart's earnings compared to its average competitor. For anyone focused on value, that is a huge red flag.
And this slide right here, it lays out that dilemma perfectly. On the one hand, the fundamental story is just fantastic. Earnings growth is over 18%, their e-commerce business is exploding, and international sales are really strong. But then you look at the other side, and the risks are just as obvious. The stock is right near its all-time high, Wall Street analysts think there's barely any upside left, and some models are screaming that it's way, way overvalued. So, what do? Well, when the fundamentals and the valuation tell you 2 different stories, you turn to your most important tool, the price chart. Now, this isn't about fortune telling. It's about using the chart as a strategic map to see where the real battles between buyers and sellers are being fought. This is our roadmap. All those lines you see, those are the critical price levels, the potential floors and the ceilings that are going to guide our entire strategy. We need to forget all the news and the noise. These lines are what really matter. So, let's break them down. Okay, let's start with the floors below us. These are the support levels, the prices where buyers have historically shown up in force. We've got a big one around $105.87, which is the 50-day moving average, and an even more important one down near $98.61, the 200-day average. These are the key zones where we should expect buying to kick in. And then, above us, we have the ceilings, the resistance levels. These are the spots where sellers tend to show up and put a lid on the price. We're bumping up against the year's high right now, and that big round number of $120 is a major psychological hurdle. These levels become our natural profit targets. All right, so we've got our map, we know where the key levels are, now we can build some actual, actionable strategies around them. And look, there's no single right answer for everyone, so we're going to lay out 4 distinct paths, and each one is designed for a different type of investor. First up, we've got what I call the conservative approach. This is for the patient investor, the one who prioritizes protecting their money and is willing to wait for the odds to be stacked heavily in their favor. So here's how it breaks down. We don't buy it here. We actually wait for the price to drop to around $108.50. Our stop loss, which is our I'm wrong exit point, is just below that at $105.87. So our total risk is just 2.4%, and our first target gives us a potential 9% gain. Now pay very close attention to that math. So, what's the thinking here? It's simple, but it's really powerful. We don't chase the stock. We let the price come to us. By being patient and waiting for that pullback, we get in at a much better price, which dramatically cuts our risk. This gives us a fantastic risk-to-reward ratio of almost 4-to-1. That is the kind of setup that professional traders hunt for. Next up, strategy number 2, the moderate approach. This is for the investor who's thinking, okay, I agree it's a bit pricey, but I'm willing to accept a little more risk if it means I can get in sooner. With this path, you'd be looking to enter on a smaller pullback to $112. You're still not chasing it at the top, but you're not waiting for that deep discount either. The trade-off? Your risk is a little higher, at about 3.1%, and your initial reward is a bit smaller. It's a balance. All right, let's talk about the aggressive approach. And I want to be crystal clear. This is the highest risk path we're going to discuss. This is a pure momentum play, and it's really only for traders who are absolutely convinced the stock is going higher right now.
This strategy means you're buying right now, at the current price, near the highs. And because you're paying top dollar, your stop loss has to be wider, over 4% risk, while your first profit target is only about 3.7% away. So let me say that again. Your risk is actually greater than your potential reward. That is not a situation professionals like to be in. And finally, we have the value approach. You can think of this as the deep discount strategy. This is for the truly patient, long-term investor who's just waiting for a big market correction to scoop up a great company at an incredible price. This strategy sets a buy order all the way down at that 200-day moving average, a level you'd probably only see if the whole market takes a dive. The risk is still well-defined, but look at that potential reward. A massive 20% gain just to get back to where the analysts think it should be. It offers the best possible return, but it demands the most patience. Okay, let's bring all of this together. This slide right here is the key summary of everything we've talked about. Look at the pattern. As you move from the aggressive strategy over to the value strategy, you are trading immediacy for a much, much better price and a vastly superior risk-to-reward profile. The professional mindset is always drawn to the right side of this table, where you risk a little to make a lot. So after all that analysis, after looking at the fundamentals, the chart, and 4 different paths, what's the verdict? What's the most prudent professional move here? The recommendation is clear, the conservative strategy. Why? Well, first, it respects the fact that the stock is expensive and demands a better price. Second, it offers an exceptional institutional-grade risk-reward setup. Third, it's anchored to real, proven technical levels on the charts. And maybe most importantly, it's about disciplined patience, not getting caught up in the fear of missing out. This is how you manage risk and stack the odds in your favor. But hold on, we're not quite done. Before a single dollar gets put on the line, a professional always runs through a final, non-negotiable checklist. Think of this as your last line of defense, your final safety check.
Here are 5 simple but crucial questions to ask. 1. Does a trusted system like Zacks Rank give it a strong buy signal? 2. Is there enough daily trading volume to get in and out easily? 3. Are company insiders buying their own stock, which is a huge vote of confidence, or are they selling? 4. Are key momentum indicators pointing up? And finally, 5, do you know when the next earnings report is coming out? That date can change everything. Running through this list turns a hopeful guess into a well-vetted plan.
So there you have it. We've walked through the entire professional playbook. We identified the core problem, we mapped out the chart, we defined clear strategies for different types of people, and we landed on a disciplined, logical recommendation. The framework is now yours. So the only question left is, which of these paths best matches your own goals and your own tolerance for risk?